So company is what? It is a artificial person having corporate legal entity distinct from its members. So who will manage each and every activities of the company? That is the directors. So what is the limit of the members and a private company? It is 200. Started as a private company with one person, and that too, that one person should be an Indian citizen and resident of India. So the OPC has to be formed only for business purpose. Hello everyone, I am Harshita, lecturer, Department of Commerce, Vidyashram PU College, the Temple of Excellence, Mysore. My dear students, today we are in the first chapter of Part B. So in your accountancy syllabus, you will be having Part A as well as Part B. So this is the first chapter under Part B of your second PUC accountancy syllabus, and the chapter name is Accounting for Share Capital. So in this chapter, you are going to learn few of the theory concepts and a very important 12 marks problem, that is a practical problem on share capital. So let us quickly begin the session. Before moving on to the meaning of company, so what is the weightage of this chapter? So you will get 1 mark, 1 question, 2 marks, 1 question, and 12 marks, 1 question. So the total weightage of this particular chapter is 15 marks. So very easy chapter. So for 1 and 2 marks, you will be getting about the theory of company accounts, and for 12 marks, you will learn about a problem, that is a problem on journal entries on share capital. So let us quickly begin the session. So first we shall learn about the company. So what is the meaning of company? So there are certain meanings are there here. So we shall go through the meaning one by one. So a company is an artificial person. So like a normal person, so company is what? It is an artificial person having corporate legal entity distinct from its members. So what do you mean by that? Here, company is an artificial person because it has its own name, it has its signature in the form of seal. So it is like a normal person, but we call it as it is an artificial person because it has some individual existence. So it is called as an artificial person which is distinct from its members. So here the company as well as the members of that particular company are not one and the same. So they are distinct from each other. So a company is different. At the same time, the members of the companies are different, and it is a legal corporate entity. So where to start a company, it's not an easy task. We have to follow certain legal procedure. At the same time, while winding up of the company also, we have to follow certain legal procedure. So a company is called as an artificial person having corporate legal entity. So it has some individual existence, and we are going to start the company legally. At the same time, we are going to end the company or wind up the company legally, distinct from its members. So here the members and the company are not one and the same. So they are different entities. That is, here we are taking into consideration. So members is nothing but what? Shareholders. So shareholders, we call it as they are the real owners of the business. So a company is different. At the same time, the shareholders or the members of the companies are two different entity and has a common seal. So it has a common seal. So we individual have the signature. In the same way, a company has a common seal used for its signature. So a company cannot sign because it is an artificial person. So the seal of the company will be used as a signature. So you have one more meaning here. A company is an association of person. So it is a association of person or a group of person who is going to start the company who contribute money or money's worth. Group of individuals or the group of people, so they contribute money or money's worth to a individual or to a company to a common stock. So where they are going to invest their money in a common stock and use it for a common purpose. In order to undertake the business activity, of course, capital is very essential. So a group of people who join together and they contribute their amount or they contribute their capital to run the business activity. That is, for a specific purpose, they are going to invest their amount. You have one more definition. A company means which is incorporated or registered under the Companies Act 2013. So the recent Companies Act is 2013. So a company means what? It has to be registered or incorporated under the Companies Act 2013 or any under, that is, or any other earlier Companies Act. So we had Companies Act 1956. After that, the recent Companies Act is 2013. So when we call it as a company, so it should be registered or incorporated under Companies Act 2013 or any of the previous Companies Act. So this is about the meaning of company. Now coming to the features of company. So let us see what are the features of company. So you might get a question, what is a company? So for 2 marks, or you can even write for 1 marks. As I told you, you will be having 1 mark, 2 marks as well as 12 marks question from this chapter. So for 2 marks also they might ask, explain any 2 features of company. So you can write any of the 2 features. So let us go through the features of company. So the first one is separate legal entity. So as I've already told you, here the shareholders or the members of the company and the company are not one and the same. They are 2 different entities. So in your first PUC, you have learnt about business entity concept. So what does business entity concept is that? Business and owner are not one and the same. They are 2 different entities. So here in the features of company, so the first feature is what? Separate legal entity. A company has a separate legal entity which is distinct and separate from that of its members. So here members means what? That is the shareholders. So the shareholders who is called as real owners of the business and the company is not one and the same. They are 2 different entities. It can purchase and sell the properties. So in the name of the company, it can sell its or it can purchase and sell its properties in its own name and can open a bank account. That is, instead of opening a bank account in the name of the members of the company, it can open its bank account on its own name. Suppose the company name is A Limited, then it can open its bank account as A Limited only. That is, it can use its name. So the bank account can be opened in the name of the company in its own name and can enter into the contract. So while entering into the contract, it doesn't mean that the members or the name of the members has to be included there. So the company can use its own name while entering into the contracts. Since a company has a legal personality distinct from that of its members, a creditor of such company can sue only the company for its debt and not any of the members. So here what happens? Suppose, as I told you, company is distinct from that of its owner. So it has a legal individual existence. So whenever the creditor of the company has given some debts to the company, so here he can sue in the name of company itself because company has a legal individual existence. If there is any creditor who has been cheated by the company, then he can sue in the court of law in the name of the company because company has a legal individual existence. That is about separate legal entity. Next one is limited liability. So if you see the members or the shareholders liability, the liability of the shareholders is limited only to the extent of amount not being paid. So if you see about sole trading concern or partnership firm, so the liability of the members is unlimited. But if you see the company, the liability of the members under the company or the shareholders is limited only to the extent of the amount which is not being paid. So the liability of the members of the company is limited. So here the liability of the members is limited. So whatever the amount which is not being paid by the shareholders, only that amount is being responsible to be paid. Other than that, their personal assets are not being affected. Whereas in case of sole trading concern or in partnership firm, so if the partnership firm or if the partners could not recover their outsiders liability, then their personal asset will be affected. But this will not happen in case of company, because each and every member or the shareholders of the company has limited liability. So the liability of the members of the company is limited to the extent of unpaid amount. So as I've already told you, so if you see the next example, you can clearly understand. So time being, you remember the liability of the members of the company or the shareholders of the company is limited only to the extent of unpaid amount. So unpaid amount of the shares held by them. So for example, if the face value of the share in a company is rupees 10. So let us take an example here. So the value of each and every share of that particular company is rupees 10 and the shareholder has already paid rupees 8. Okay. So out of 10 rupees, he has already paid 8 rupees per share. He can be called upon to pay not more than 2 rupees per share. So what happens? So the actual value of the share is rupees 10. Where the shareholders had to pay rupees 10, but he has paid only rupees 8. Okay. Then the liability of this shareholder is amounted to be paid only to the extent of amount which is not being paid. So what is the amount which is not being paid? That is 2 rupees. Correct? So here the liability of the members is only to the extent of the amount which is been not paid. So other than that, the company cannot ask extra amount from the shareholder. So the liability of the members under the company is limited to the extent of unpaid amount on a particular share. Now coming to the third feature, perpetual succession. So what I mean by perpetual succession? So company means what? It is a large business. It's not limited to only a particular confined activity. So it is a very large business where number of activities, number of transactions takes place daily. So perpetual succession in the sense, the company will continue for a longer period of time. So whenever they start a company, so they have to have a goal that the company will start for a longer period of time. So people may come and go. So in a particular organization, people may come and go, but the business will continue for a longer period of time. So if you see about the partnership firm, what happens? So if a partner dies or if a partner retires, so they have to change their partnership agreement. With a new agreement, they have to continue their business activity. For time being, they'll stop their business activity. With a new agreement, they will continue. But in case of company will not be closed. It will be continue for a longer period of time. So people may come and go. What does it mean? The vice president, the CEO of the company, the manager of the company or the employees of the company might change year after year. So, but the company will not stop. It will continue for a longer period of time. So, you have learnt about going concern concept. So, what does that concept tells that? People may come and go, but the business will continue for a longer period of time. So, always the company or always the members of the company has to keep in mind that the business will continue for a longer period of time. So perpetual succession in the sense, the existence of the company is not limited to a confined period. It will continue for a longer period of time. So the existence of a company is not affected by the retirement, death, insolvency of its members. So it is not affected by any of the, if anyone retires or if anyone dies in the organization, it will not be affected. Shareholders may come, go, but the company goes on forever unless wound up according to the Companies Act. So, unless according to the Companies Act, it is going to wind up, rather than that, the company will continue for a longer period of time. So, here, people may come and go, but the business will continue for a longer period of time. And the next feature is that common seal. So as I've already told you, the company is like an artificial person. So we call that company is an artificial person because it also has some individual existence. So since the company has no physical existence, it must act through the agents called directors. So since the company cannot manage all of its activity, so who will manage the activities of the company? That is directors. All documents prepared by the directors must bear the seal of the company. So here the seal of the company acts as a signature. So like a normal person, company act as a artificial person where it can put his signature in the form of company's seal. The company seal act as the official signature of the company. So as I've already told you, so who will manage each and every activities of the company? That is the directors. So directors can use the name of the company. It can use the seal of the company as a signature. Next one is transferability of shares. That is, one who holds shares is called as shareholders. So in the company, how they are going to transfer the shares? The capital of the company is divided into parts called as what? Shares. So you will learn about shares particularly in this particular chapter. So here the total capital is being divided into number of small units, which is called as what? Shares. Now this is the total capital of the company where each or the total capital is being divided into number of smaller units, and this each unit is called as what? Shares. So this each individual unit is called as shares. So the capital of the company is divided into parts called as shares. These shares are freely transferable. So until there is a condition, so these shares can be easily transferred from one person to another. So the transferability of shares can happen in case of company. So transfer subject to certain condition. So based on terms and conditions, the members or the shareholders of the company can transfer their shares to some other person. That is, there is transferability of shares. Next one is body corporate. So generally in India, companies are formed and registered under the companies law. So as I told you, so in order to start or in order to wind up a company, so there should be certain legal aspects to be followed where the company will be started according to Companies Act. That is, it may be Companies Act 1956, which was a earlier Companies Act, and the recent Companies Act is Companies Act 2013. So any of the Companies Act, that is either Companies Act 2013 or any other previous Companies Act, so it is incorporated or it is been started according to the Companies Law or Companies Act. Next one is separation of management from ownership. So as we have already discussed that shareholders and the company are not one and the same, they are two different entities. So they are distinct from its members. So shareholders are the true owners. So we call it as shareholders are true owners or real owners of the company. But usually the number of shareholders is quite large, and as such it is neither possible nor desirable to each member to take part in the day-to-day management of the business activity. So as I told you, if you think about the company, it is not a small organization, it is a huge organization where there will be number of members whom we call it as shareholders because they holds the shares of the company, and shareholders are called as real owner of the business. So being the real owner of the business, they cannot undertake day-to-day activities of the business because there are huge number of shareholders, because the capital of the company is very high. In the same way, the number of shareholders of the company is also very large. So each and every shareholder cannot undertake the business activity. So in spite of shareholder, who will take the activities or who will take all the managerial business activities of the company? That is the directors. So directors will be appointed by the shareholders. So here the equity shareholders has a right to vote. So based on the vote of the shareholders, directors will be selected and those directors will undertake the managerial activities of the business, not the shareholders. Even though they are the real owners, they cannot manage the activities of the business. So the activities of the business will be managed by the directors who is selected by the shareholders by their votes. Therefore, the company is managed by board of directors. So, board of directors is elected by whom? That is elected by the shareholders by their voting rights. So, managed by the board of directors, elected by the shareholders. So, these are the features of company. Now, coming to kinds of company, that is on the basis of liability of its members. So, it has been divided into unlimited company. So, there are two more types. So, first we shall learn about unlimited company. Now, what do you mean by unlimited company? So, it is a company where there is no limit on the liability of its members. So, normally I have told you the members of the company is limited. That is, the liability of the members of the company is limited only to the extent of unpaid amount. But in case of unlimited company, so where there is no limit on the liability of its members. So, here there is no limit. It means when a company suffers loss and the company's property is not sufficient to pay off its debt, the private property of its members will be used to meet the claims of the creditors. So, what do you mean by unlimited liability? So, suppose if a business organization is there in a huge loss and they are not able to recover those loss by the company's property, then the property of the members will be affected. So, the property of the personal asset of the members has to be sold and the amount that has to be paid to the outsiders, that is outside creditors. So, here under unlimited company, the liability of the members is unlimited. There is no limit on the liability of its members. So, if the company incurs loss, then what happens? The personal asset of the shareholders will be affected. As the risk involved in such companies is too high. These are not found in India even though permitted by the Companies Act. Even though it is permitted by the Companies Act, but it is not followed in India. So, this is about unlimited company. Next one is company limited by guarantee. So, in case of such a company, the liability of the members is limited only to the extent of guarantee given by them in the event of winding up of the company. So, what do you mean by company limited by guarantee? So, here the liability of the members will be only to the extent of guaranteed amount by the shareholders. So, the liability of its members will arise only in the event of winding up of the company. So, when they are going to see their liability only in case of winding up of the company, and that too while winding up, so the liability will be only to the extent of guaranteed amount by its members or by its shareholders. Next one is company limited by shares. So, in case of such a company, the liability of the members is strictly limited only to the extent of unpaid amount on its shares. So, as we have already learnt, that is already we have seen an example there. So, if the value of each and every share is rupees 10 and the shareholder have paid rupees 8, so he is liable only to pay rupees 2, that is the unpaid amount. So, here company limited by shares means what? In case of such a company, the liability of the members is strictly limited only to the extent of nominal value of shares held by them. So, only to the unpaid amount they are liable. If a member has already paid the full amount of the shares, he is not be liable to pay any of the amount. So, if he pays all amount, that is all amount on his share, then no need to pay any of the amount. If he has paid only half, then rest half has to be paid. So, his liability will be only to the extent of unpaid amount on individual shares. If a member has partly paid shares, he can force to pay the remaining amount during the existence of the company as well as during the winding up. So suppose he has paid only half amount, then rest half amount will be forced by the company to pay by the shareholders. So here that half amount can be forced by the company to pay during the existence of the company or during winding up of the company. So such companies may be subdivided into private company, public company and one person company. So we shall discuss in detail what is this private companies, public company as well as one person company. So private company. So the first type is private company. So what is this private company? As per section 2 subsection 68 of Companies Act 2013, a private company is one which by its articles of association, so there are certain conditions which is given under Companies Act 2013 in its articles of association. Let us see what are the conditions which has to be followed to be a private company. So the first one is restricts the right to transfer its shares. So in the features of the company, I have already told you the shareholder has a right to transfer its shares. But in case of private company, it restricts, your Companies Act 2013 restricts private company to transfer the shares from one person to another person. Suppose I am a shareholder, so I'll be having the share of a private company. I cannot transfer my share to some other person. That is in case of private company. Limits the number of its members to 200 exclusive of past and present employees. So the total number of members under private company is how much? That is 200. Prohibits any invitation to the public to subscribe for its security. So before the company wants to issue shares to the public, so it has to invite the public, which is called as what? Prospectus. Now what do I mean by prospectus? It is an invitation to the public to subscribe for its shares. But in case of private company, it prohibits that invitation. So here the private company cannot issue prospectus to the public while inviting for its shareholders. So prohibits any invitation to the public to subscribe for any securities, that is shares or debentures of the company. The name of every private company must end with the words that is private limited. Now what you have to remember under private company, so the first condition which is given under Companies Act 2013 is that it restricts the right to transfer the shares. So under the private company, the shareholders of the company cannot transfer their shares from one person to another. And the next one is limits of the members is how much? That is 200 members. So it includes or exclusive of past and present employees. So the members. So what is the limit of the members under private company? That is 200. And it also prohibits restriction while inviting the public by issuing the prospectus. So here the private company cannot invite the public by issuing the prospectus, that is while issuing the shares or debentures to the public. And one more thing is that the name of private company should end with the word private limited. That is A private limited. That is, suppose if the company's name is A private limited. So it should end with the word private limited. Now coming to the next type of company, that is public company. So as per section 2 subsection 71 of the Companies Act 2013, a public company means a company which is not a private company. So this is a simple meaning here. A company which is not a private company, of course it should be a public company. Then what are the conditions which are there in the public company? So it is reverse to your private company. So what are the conditions? So under public company, there is a transferability of shares from one person to another. So if you see the public company, under private company, it restricts the transferability of shares. But in case of public company, they can transfer, or the shareholders can transfer their shares from one shareholder to another shareholder. And if you see the second condition, so the limits of the member, so the limits of members under private company is 200. But in case of public company, it is unlimited. So what is a limit of public company? That is, the number of members is unlimited in nature. And the next one is prohibits invitation. So as I told you, in private company, they cannot issue prospectus to the public while inviting their shares. But this will not happen in case of public company. They have the right to issue the prospectus. So they can invite the public to subscribe their shares and debentures. And here the name of the private company must end with the word private limited. But that will not happen in case of public company. So it did not end with the word private limited. Okay, so these are about public company. So it is just opposite to your private company. And the next type is one-person company. So we call it as OPC, one-person company. So let us see what is this OPC. So Companies Act 2013 introduces a new type of entity to the existing list. That is, to the existing list of public and private company. Companies Act 2013 have added one more type of company, that is one-person company. Apart from forming a public and private limited company, the Act enables the formation of new entity which is called as what? One-person company. Rather than public and private company, one extra type of company is being introduced under Companies Act 2013, what it is called as one-person company. So an OPC means private limited company with only one person as its member. So what do you mean by OPC? So it is a private limited company with only one person. Okay, so just you have to know what is the meaning of these companies. Okay, so as I told you, you can expect 2 as well as 1 mark question. So you can go through this theory part. So following rules are applicable on OPC. So let us see what are the rules that has to be followed under OPC. So the first one is members of OPC. So as I told you, it is a one person. It is a private company which is started by one person. Okay, so only a natural person. So here it is a natural person who is an Indian citizen and resident in India can become the member of OPC. So it has been started as a private company with one person, and that too, that one person should be an Indian citizen and resident of India. The term resident in India means the person who has stayed in India for a period of not less than 182 days immediately preceding one calendar year. So if you see preceding one calendar year, so that person should be resident in India only if he should stay in India for not less than 182 days. So one person company can form only one OPC. So that person who is going to start the OPC, he can start only one OPC, that is one person company. So its paid up share capital should not exceed rupees 50 lakhs. So what is your paid up capital? So it should not exceed rupees 50 lakh. Its average annual turnover. So if you see the average annual turnover of 3 years should not exceed rupees 2 crore. So if they fulfills these conditions, then only it is called as OPC, that is one person company. Now if you see the next one, purpose. So as per rule 3, sub-rule 5 of the Companies Rules 2014, and OPC cannot be formed for charitable purpose. So it should be business purpose only. So OPC has to be formed, or it should be run for business purpose only, and it should not be formed for charitable purpose. In other words, it can be formed for business purpose only. So as I've already told you, so the OPC has to be formed only for business purpose. Next, conversion. An OPC cannot convert itself into public or private company unless a period of 2 years has expired. So unless 2 years has been expired, it cannot be converted into public or private company. It has to remain as OPC only from the date of its incorporation, and conversion is mandatory when the paid up share capital is increased beyond 50 lakh. So here I have already told you, so its paid up capital should not exceed 50 lakh. Suppose it exceeds 50 lakh, then a compulsory conversion has to be made either to public company or to the private company. 50 lakh or its average turnover during the relevant period exceeds 2 crore. So if they cross that Companies Act 2013 rules, then it can go for conversion. Other than that, it cannot convert into public or private company. So this is about OPC. So you can go through the meaning here. So you can see what are the conditions to be followed, what are the types of company, what are the features of company and meaning of company. So in my next session, we shall discuss the next part, that is we shall learn about shares, nature of shares, types of shares, distinction between equity shares and preference shares. So these are the two important types of share, that is equity share and preference share. So we shall see the difference of it. Next, share capital of the company. So why we call it as share capital of the company, or what is share capital of the company? Next, issue of shares. So how they are going to issue the shares to the public. Next, accounting treatment. Of course, we have to maintain proper accounts of the company. So in related to shares, what are the accounting treatment we have to make? So these are the few topics what I am going to discuss in the next session. So my dear students, hope you have understood today's session. See you all in my next session with the new topics. Till then, take care. Thank you.